Hi all and welcome back to this series of Learning Simplified. So in this session we are going to understand how loan provisioning works, what is the concept of provisioning. So first let's try to understand what exactly we mean by provisioning. Now provisioning is booking a provision, means that the bank recognizes a loss on the loan ahead of its time. So as we know that the bank provides loans to its customers, and there is a probability that the customers may not repay the loan either partially or fully. So the bank needs to be prepared for such an eventuality instead of recognizing it at the end when the customer doesn't turn up. So for example, when a loan is booked for $100,000, your loan asset increases by 100,000. But at the same time, a provisioning kicks in. Let's assume a provisioning percentage of 10. So you actually expense this 10,000 or the 10% of 100,000 and credit to the provisioning GL, which is a liability GL. Now, next month, the customer might have paid 20,000 of the 100,000. Then what happens for the next month's provisioning? You reverse the provisioning done here, 10,000, and then a new provisioning amount of 8,000 kicks in, 10% of 80,000, because 80,000 is the new outstanding loan amount. And every month such a provisioning is calculated. So a provisioning percentage is applied on the loan outstanding balance. Now, what are the factors which determine the provisioning rate? In the previous slide, we saw 10%, but is it fixed? No, of course not. The factors are the credit rating of the customer. If the customer has a very good rating, the provisioning percentage reduces. And of course, its profile. For example, a salaried customer's provisioning percentage might be lesser than a non-salaried customer. Secondly, the type of loan, a mortgage loan, personal loan, a business loan, and so on. More often, mortgage loans sees lesser default and hence a lesser percentage of provisioning may apply vis-a-vis a personal loan. Thirdly is the collateral backing of the loan. So in the previous example of 100,000 USD loan, if there was a quality collateral of 20,000, then the 10% will not apply for the whole of the loan, but rather for the 80,000, which is the unsecured portion of the loan. And finally, the NPA bucket of the loan, for example, the non-performing asset bucket of the loan. Now, if it's a normal loan, you might be attracting a 10% provisioning. These are just examples, by the way. If the loan becomes unpaid for, let's say, 30 days, the loan bucket moves to substandard. It attracts a higher provisioning percentage of 20. 60 days to 90 days, doubtful, provisioning percentage increases 30%. Loan is not paid for, let's say, 180 days, the loan bucket goes to loss and you might be provisioning 50% of it. So obviously these are examples, but the important thing here is to understand that the percentage keeps on changing based on the NPA bucket the loan is classified under. And of course, this goes without saying, there are regulatory guidelines which the bank needs to adhere to when arriving at the provisioning percentages. Obviously, the provisioning can be done manually by the bank on an ad hoc basis, or in the loan processing system, you can set it up to be automatic based on a particular frequency. It could be daily, monthly, fortnightly. Generally, we have seen it being done monthly because every month the loan outstanding changes, the credit profile of the customer may change, the NPA bucket might get changed, the regulatory guidelines may change. So based on all these factors, the provisioning percentage will change, and obviously the provisioning amount keeps on varying month and month for the same loan. Of course, this is to be informed here that this can be more complicated than what has been depicted here. So sometimes there are specialized rule engines external to the core banking which does all these calculations based on all these factors. They arrive at the provisioning amount and they feed it into the core banking or the loan processing system to actually pass the accounting for provisioning. So it may not be as simple as this slide shows, but overall, I think you would get a fair idea of how provisioning is calculated, why it is required, and so on. So thank you for the session, and in the next session, we are going to understand more about off-balance sheet. So till then, thank you.